Hello and welcome back to another video. In this video, I'm going to be providing an update on Alibaba, ticker symbol BABA. I put out a video on Alibaba a few weeks ago going deep into the business operations and analysing the stock. I also provided you with a 5 and 10 year financial model showing the stock as significantly undervalued in each scenario. It's safe to say the stock is even more undervalued given the recent drop to 220. I personally think at this price, Alibaba is one of the best mega cap public investments available in the current market. And in this video, I'm going to break down why. Full disclosure, I do own Alibaba stock, as I said in the previous video, but I will do my absolute best to conduct a non-biased case as always. I'm going to be laying out all the concerns you should have as well as some of the positives. This, of course, is just my opinion and not meant to be formal financial advice to go and buy the stock. I'd say use this as a piece of research and go and do some more on your own to make a decision on buying thereafter. So first, let's take a quick look at what has caused the stock to drop almost 20% in one day. We're going to listen to a short clip from CNBC which outlays what the current situation is quite well and gives us some good information on why the investigation is taking place. After that, I will give my honest opinion on what is happening, why it's happening, and what we can expect as a result of it.
Good morning, Andrew. So today, the country's top market regulator said that it's opening an investigation into Alibaba for alleged monopolistic behavior, what's known, especially here as a common practice, as pick one of two. So this is forcing merchants to work only with the e-commerce giant as opposed to any of its rivals. Separately, Ant Group was called in for a discussion, summoned to talk about fair competition and consumer protection. So all of these moves come at a time when Jack Ma, only a couple of months ago, had made a fiery speech where he was highly critical of the regulators, and also at a time when Beijing, and in particular the Xi Jinping administration, is looking to exert more control over private industry, ostensibly to weed out some systemic risk. So there's been a lot of talk now today about what the potential impact could be on Chinese tech. Most people here are saying that they expect the enforcement to come into play, that a lot of the larger Chinese tech companies are going to face several potential penalties, such as everything from slap on the wrist fines to demands for restructuring of their business model. And then the nightmare scenario that's been discussed is a possibility to the end of the VIE structure, which is a structure that allows foreign investors to buy into some of these Chinese tech firms. So a lot of discussion here, a lot of concern, but one thing that is the saving grace, at least discussed here among Chinese tech folks, is that these Chinese tech companies at the end of the day are important to Beijing because Beijing wants to have national champions. And we saw that reflected in the state press when the official People's Daily, very soon after this announcement came out, had written up how, though it's in favor of this investigation, that the purpose of the investigation is only to have better development of the online economy as opposed to anything else.
To be honest, this isn't exactly new news. We already knew that Alibaba was being investigated by the Chinese authorities in relation to very vague antitrust rules, if you can remember. At the time, the stock dropped from 310 down to around 270, so we had about a 15% drop there. And it was because new rules and regulations were to be drafted by authorities and meetings were to be held with Alibaba and Ant and Jack Ma to discuss changes that will be required in the business operations for Ant to go public. And all that's happened now is the Chinese authorities have confirmed that Alibaba is set to be the first tech giant investigated, and they haven't given a great deal of information as to what will happen, but it's well documented that the basis for investigation will be around some of Alibaba's monopolistic practices, including Alibaba's tactic of forcing merchants to sell exclusively on its platform, a practice well known as pick one of two in China, and among some other issues as well. An antitrust expert at a Chinese law firm has said that in a worst case scenario, Alibaba could be fined up to 10% of the previous year's sales, which would be about 7 billion. But the aim of the Chinese authorities, from what I can gather here, is to work with Alibaba and Jack Ma to help supervise and guide its companies on issues related to fair competition and consumer protection. I wouldn't be surprised if this led to, some anti-monopolistic rules being written up and the choose one of two practice being made practically extinct. Of course, this would take away a certain strategy for funneling revenues through Alibaba's platform rather than the competition, but it is definitely not the end of the road for them. Okay, so now I'm going to jump into a little bit of analysis, analyse the current position. I'm going to give 3 strong reasons why I don't see this punishing Alibaba investors for the long term, and why I think it is still, or even an even better investment than it was before at this level. But I'm also going to give 3 going concerns that you'll have to think very carefully about and balance them against each other. So let's just jump into that. Okay, so here's 3 strong reasons why I don't see this punishing investors for the long term and why it's still a convincing buy for me at this point. So first of all, Alibaba is the titan of tech for China and almost acts as their poster child to the rest of the world in terms of their ability to compete with the West in technology and innovation. I very much doubt that they are looking to tarnish this with strict sets of rules for limiting the size and pace of growth as well as the ability to innovate. It is very much in their best interest to keep Alibaba as an international tech powerhouse, and Ray Dalio and some other Chinese economic experts seem to think the same, so we are in good company. As you can see, I've got down here 3 of the more successful hedge fund managers of the last decade have bought Alibaba in the recent quarters, and they've bought at a price range that is actually above, or should be above, where the stock is sitting now. So in terms of smart money, we're in quite good company. Second, the drop to $220 per share means that Alibaba is selling at 21 times fiscal year 2021 earnings per share, or an earnings yield of almost 5%. And that fiscal year 21's March 2020 to March 21, so it's almost the current earnings per share. That is cheaper than the S&P 500 and expected to grow at a rate above 25% for the next 5 years against the S&P's 10%. If they grow earnings at the expected rate, you would have an earnings yield of 15% in 2025. There's not many places in the market that have the same potential as that. Also, with this new price, Alibaba could see estimated growth actually slow significantly, say by 10%, and still outperform the market in both underlying results and stock performance. 3, this sort of news is hurtful to the short-term trader or investor who is looking for catalysts that lift the stock in the near term. So these type of investors do not wait around longer than 6 months for a stock to return a profit. They usually apply stop losses or other means of selling to get out of the position and move on to something else. With a highly liquid and volatile stock such as Alibaba, you are bound to have a large amount of short-term players, thus creating a mass sell-off when bad news occurs. These short-term issues create great buying opportunities for investors willing to weather the storm. Just look at Facebook in 2018 as a great example. The Cambridge Analytica scandal sunk the stock by around 40%. Everyone rushed out of the stock due to unknown implications of government investigations and intervention. It almost seemed like the end of the road for Facebook, but of course it wasn't. Facebook continued to grow and produce great profits for investors. If you bought the stock near its lows in 2018, you would have made a 115% return, or a 50% annual rate of return. I see this current issue for Alibaba as something similar in nature, and I can see it working out, maybe not exactly the same, but in a similar fashion. Now, I'd like to list some of my going concerns with this whole saga. There is, of course, concerns. It's not an absolute given that Alibaba will come out of this as strong as it is now. So, first of all, in a worst case scenario, experts believe Alibaba could be fined up to 10% of last year's sales, which is in the realm of around $7 billion US, and this would eat into next year's earnings and free cash flow, technically making the multiple we pay for the stock higher than it may seem now. However, this is a short-term issue and a one-off expense. Investors willing to see past it will not be too worried. Secondly, the potential that China introduces anti-monopoly laws that restrict Alibaba from using strategies that help them retain revenues on their platform. This is actually quite likely to happen. However, Alibaba is just the first to be targeted due to its dominant position and the volume of complaints that authorities have received. it is likely that all the big tech names, such as Alibaba's competitors, will be mandated to follow the same rules, which makes it an even playing field, meaning the business with the best platforms, services will benefit. And for reasons I've covered in the previous video, I believe Alibaba is the clear winner. Third, Chinese authorities try to slow Alibaba's growth to prevent it getting too big. This is probably the greatest concern of all for investors. However, I think it's the least likely to actually happen. As I mentioned earlier, Chinese authorities are very capable and quite business savvy. They appreciate the significance of Alibaba internationally and see it as a means of competition with the West. The Chinese economy is expected to continue growing at a rate of around 7% for the next 5 years, and have industrial and financial companies that dwarf Alibaba in terms of revenue and customer count, although they are mostly state-owned companies. The point I'm trying to make here is that, one, it's very unlikely they will mandate slower growth or break up the company. Two, if they do, it's unlikely they would mandate slower growth than the economy itself, which is around 9 to 10%. And as we already covered, as the stock's got so cheap now, even a 10 to 15% growth rate in earnings over 5 years wouldn't make for bad stock performance. In my opinion, the reasons for investing in Alibaba outweigh the going concerns. You may think otherwise, but hopefully I've outlined all the realistic possibilities for you to make a decision. Now, I'm going to return to the numbers and run a few scenarios in an IRR for Alibaba to see what kind of return we can now expect from the current stock price after the drop, if all goes to plan. Okay, so I've drawn up 3 scenarios here. As you can see, I've got, first of all, a base case, so nothing really changes from the valuation that we had done recently on Alibaba. They continue to grow at around about 25%, or earnings continue to grow at 25%, and then they're selling at a PE multiple of 25 times, which it's rarely dipped below in its history. So that's a fair multiple to set as a terminal value in year 5. We've got a bearish case where Baba is affected by, say, new anti-monopolistic rules and sales growth slows around 10%, meaning that they're growing at 15 to 20%. And then a slight margin improvement as expected from things such as cloud, which are not yet profitable. And in scenario 3, we've got a worst case scenario where the Chinese authorities decide to punish Alibaba and mandate tech companies have a growth cap to stop them becoming too powerful. This would limit Alibaba's growth to around 10 to 15%, around the rate of the economy. Margins will again improve slightly as expected due to the divisions of the business such as cloud, which are not yet returning a profit. And also, the point of the Chinese intervention will not be to make the company less efficient, just penalise size. Okay, so as you can see in the base case, I've got the expected fiscal year 21 earnings per share. This is just a basic earnings model. The free cash flow per share actually pretty much mirrors the earnings per share, or is slightly more than it. So we're going with earnings per share in here. So it's more of an earnings model, but because it's an IRR, we're okay to do so. So I've gone with fiscal year 21 earnings on all of the scenarios. As you can see in this base case, we still get a 37% IRR from the current price. This is factoring in the earnings as if we're collecting the earnings going into shareholders' pockets. If we just forget the earnings for now and just went from a buy price to sale price, we still have a 30% return. So, in my opinion, one of the best available returns in the market for something the size of Alibaba. Now, if we move down to the bearish case, where earnings are only growing at 17.5% and the PE multiple drops to around 22, which is near its all-time low, we still get an IRR of 25%, with $433 per share being the expected terminal value. Okay, and in the worst case scenario, you can see I've gone with a 12.5% growth rate and the PE multiple drops to 20 times for our terminal value. We still get an IRR of 18% in the what I would class as realistically the absolute worst case scenario, with earnings only growing to $16.50 per share and the terminal value being $330 per share in 2025. I mean, if you think about $331 per share, the company, The stock almost reached that in August, I think it was. So not too hard for it to get to that point. Now, these are all based off of us receiving earnings, or the theoretical point of earnings going into our pockets as shareholders. So if we just take that out of the equation for now and look at the IRR based just on the buy price and sale value, then we get 30%, 18%, and 11% respectively. So, the worst possible return indicated to us here is anywhere from 11 to 18% in this worst case scenario. I could potentially introduce a scenario for which would be Alibaba's companies being forced to split up and create a larger set of individual companies. And to be honest with you, this would be near impossible to demonstrate in an IRR and is unlikely to happen, in my opinion. Also, if it does, there is no guarantee investors would be worse off. Some analysts claim Alibaba has actually always been undervalued when valued on a piece-by-piece basis. Of course, the main thing is that it would still cause a headache to most investors and definitely send shocks through the stock. So that is about it for my update on Alibaba, guys. In summary, I would say if you currently hold the stock, don't sell just based off of this news. If you were thinking about buying more, it may be a good opportunity to increase your position. If you don't own any Baba and have been waiting for a discount, it seems to me like a great opportunity to finally enter the stock. Let me know in the comments down below what you think of the current sell-off and if you are long Alibaba or not. Leave a like if you enjoyed the video and subscribe to the channel for more analysis and valuations. Until next time, good luck with your investments.